Welcome back to the Wall Street Podcast. Today is August 29, 2025, and we're digging into some key reports fresh from the Wall Street Journal. Our goal, as always, is to pull out the critical insights shaping the markets and policy. We're looking at U.S. economic performance, some interesting dynamics around the Federal Reserve, and how tariffs are hitting prices.
Right, and pulling these threads together paints a pretty complex picture. You've got real innovative growth on one side, but on the other, some persistent challenges, policy questions, inflation worries. It's quite the mix right now.
Definitely. Let's start with that growth picture. The Commerce Department revised the second quarter U.S. GDP growth figure.
Yes, revise it up to an annualized 3.3%. That's noticeably higher than earlier estimates, added about $20 billion more to output.
And the drivers. Consumer spending was solid, but the big story seems to be AI investment.
Absolutely. Investment in software, specifically related to AI, grew at its fastest quarterly clip since, well, at least 2007. It shows where the momentum and the money is heading.
But it's not all dooming, is it? The labor market seems cooler.
That's fair. Initial jobless claims fell slightly to 229,000. Continuing claims are around 1.95 million. It suggests some slowing.
Yet the unemployment rate itself has been stuck at 4.2% for a whole year now. So cooling, but maybe not dramatically.
Exactly. And alongside that, you have the housing market. It's still really struggling. Pending home sales dropped again in July, 0.4%.
Missing expectations for a rise, right?
Right. And the main culprit seems to be those persistently high mortgage rates. It's just a major affordability hurdle. An interest rate cut would help, but for now, it's a significant drag.
Okay, so a mixed economic picture. And then there's this political dimension heating up around the Fed.
Yes, quite unprecedented. Federal Reserve Governor Lisa Cook filing a lawsuit against President Trump to block her potential firing. That really tests the president's power over the Fed.
But the market reaction was surprisingly quiet.
Muted, yeah. It suggests investors maybe aren't seeing this as an immediate threat to monetary policy direction, or perhaps it was already somewhat anticipated.
Interesting. And despite this, the Fed is still openly considering an interest rate cut, maybe as soon as September.
That's the signal. Chairman Powell even suggested that these price increases we're seeing from tariffs might not translate into a long-term inflation problem. He seems more focused now on, perhaps, the job market softening.
Which brings us neatly to those tariffs and prices. Companies are acting.
They are. We're seeing announcements from Hormel Foods, J.M. Smucker, Ace Hardware, all planning price hikes.
And they're explicitly citing rising costs, including tariffs.
It's not just them. Big retailers, too. Walmart, Target, Best Buy are all indicating they expect tariff-related price increases to hit consumers.
So it's passing through.
It seems to be. Dollar General is an interesting case, raising prices, yes, but also actively trying to shift production to mitigate those costs. Shows the pressure they're under.
And consumers, how are they taking it?
It varies. Some seem to be accepting the increases, maybe for now, but particularly lower-income shoppers, they're reportedly trading down to cheaper alternatives. You see the strain there.
Okay, lots happening. Let's try and crystallize this with a few key questions. First module, economic momentum, that strong Q2 GDP fueled by AI and consumers. How sustainable is that when labor and housing are looking weaker? What should we watch?
Good question. The AI investment is clearly a powerful force, but sustainability. I think you need to watch consumer behavior very closely. How adaptable are people really to these rising prices, especially for essentials? It's not just about trading down. Will it force a more fundamental shift in spending? And can growth be broad-based if housing remains stuck? Those are the key factors beyond just tech investment.
Right. Module 2, Fed independence.
Yeah.
The market basically shrugged off that Cook lawsuit. Does that mean investors just assume the Fed's core functions are safe from political interference, especially regarding that potential September rate cut?
I think the muted reaction suggests one of two things. Either the market had already factored in this kind of political friction, or more likely investors believe the Fed's decision-making process, particularly on rates, will ultimately rely on the economic data, not these political battles. Their focus seems locked on inflation and employment figures as the real drivers for policy.
Okay, module 3, tariff inflation. Powell seems somewhat dismissive of tariffs causing long-term inflation, but we have companies like Hormel and Walmart saying, yes, tariffs are forcing us to raise prices. How does this square? Does it complicate the Fed's path to its 2% target?
It certainly highlights a tension. The company announcements show a clear cost pass-through is happening now. If that becomes widespread, especially hitting everyday items, it absolutely fuels inflationary pressure. It could make hitting that 2% target harder and might, dampen overall consumer purchasing power, regardless of the Fed's current assessment of the long-term pattern. It's a direct hit to consumers.
And that's the bottom line for you, our listeners. These aren't abstract numbers. They translate directly into the prices you pay at the checkout,
Yeah.
the cost of financing a home.
Exactly. And for investors, understanding these shifts, the economic currents, the policy debates, the corporate responses is fundamental to navigating the markets. So this dive into today's Wall Street Journal reports really shows that complexity, genuine innovation happening alongside some serious headwinds from policy and inflation. It leaves us with a thought. In this environment shaped by rapid tech changes, shifting monetary policy, and corporate reactions to things like tariffs, how are you adapting your decisions for the quarters ahead?